Welcome to secret number 4, which is refinancing consumer debt as a tool. So, this is probably potentially the most complex because there's a lot to understand about consumer debt. You may have run into certain information on YouTube about it, and there are various concepts you need to be aware of, like the debt mix. What's your debt mix? Which is there are different types of debt. You have consumer debt, revolving consumer debt, where it's unsecured credit cards, lines of credit. And then you have installment loans, which could be secured or unsecured. Unsecured would be that's a car loan. And then you have things like mortgages. And the more robust of a combination of these things that you have, potentially the higher your credit rating will be. And if you're having financial trouble, potentially the lower it can be. So that, knowing how to work that is very useful. Even at the bird's eye view, you have the basic concept of paying your debts on time, being about 35% of your credit score. And on your revolving consumer debt, what's your utilization rate? If it's 30% or less, that's a very good debt. If it's 10% or less, you're in the excellent category. So how much you use of your revolving consumer debt is one thing. The other aspect is you have to look at your debt to income ratio, especially for major purchases. They look very closely at that. They also have different types of credit scores. So the credit score that they model, with the scoring model, it's a term that they would look at to consider you for a mortgage is going to be a bit more harsh typically than one for a car or for a credit card. So you need to learn about those. And that information is online. Credit scoring models. Just Google that, or you can go to YouTube and it's like, what are the different credit scoring models for Experian, TransUnion, Equifax? Those are things that would be very beneficial for you. Now, before I dig too deeply into the nuts and bolts of this particular secret, the importance of family buy-in can't be overstated. You have to be on the same page, or you might as well be trying to hold back the ocean in the room because you can have one party, yourself perhaps, acting to solve the problem, and then, oh, we got more money. That means we can spend more. If the other half is doing that, then you end up essentially going in circles and accomplishing nothing, and perhaps even making the problem worse. And you end up becoming a slave, even more so than you might already feel. So, again, if there's open, clear communication, which I've discussed in other modules, then it's easier to hold one another accountable. So, having said that, let's say that one of the temptations is that major purchase, or oh, it's my birthday. Maybe I need to do a cell phone. Whatever your little vice is. The process just won't be sustainable because as soon as there's room on a credit card or a line of credit, it's gonna be eaten up again. And again, you're back to square one. And this can happen in 30 days or less too. So as well as falling out. Now, with secret number 4 here, the refinance, there are also some limitations on it where yes, you can accomplish a lot in 30 days. I personally have, but this might require a longer time horizon. So you can be looking at 60, 90, even 120 days before you see results. Because it requires certain consistency and in your lifestyle and cutting back in your I don't like to use the word austerity because it sounds so harsh. Maybe it is. If that's what you need to do, you need to do it. So getting out of debt has to be a shared objective. It's just not going to work otherwise. If you're single, then you're the only one you have to be concerned about. That person over there that you see everywhere, most times. And if you're the one with the spending problem, then yeah, you can work harder, but you're the person you're fighting. And it might be the case if you're in a relationship too. Maybe you both have a problem. I don't know. But you have to be honest with yourself about it. In a family, yeah, it has to be a shared objective. Otherwise, it's not going to work. So have that open discussion with a partner, other half, spouse. It may end up seeming rude talking about money because in our culture, especially here in the States, historically, we haven't talked about our personal finances. Because we're always worried about getting the finger pointed at us and say, look what you've done, money person. So and then nobody likes the accountability. It's like, well, I earned it, it's fine. It's a very sensitive issue, and it can be very hurtful. Um, but at the same time, if there's no accountability, then this isn't. Now, another thing you need to consider is if you are single and are getting into a relationship, one of the other aspects that you're going to have to consider is open, clear, and frank communication about money. Because if you don't have the conversations and get on the same page about it before the relationship, you're just going to perpetuate problems during the relationship if both don't have a similar or complementary sense toward money, what it's for, what it's not for. So make sure that you have the discussion before you sign the apartment lease, at the very least. After this, assuming that everybody's finally in consensus, either you with yourself or with your significant other, the end objective of refinancing your consumer debt may initially require cleaning up your credit score to qualify for the financing in the first place. So that might be that 60, 90-day thing. It doesn't take as much time as you might think to make it happen, but I also don't want to give you a false expectation in this particular module, because again, this can be a bit more complex. Um, Looking into web-based lenders nowadays, interest rates can vary from 6.99 to 26.99. So yeah, 7 to 27%, some of them even higher. And those variables are determined by, of course, multiple factors: your credit mix, your timely payments, but also the amount of the loan, the payback period. Do you want the loan 3, 5 years, 7 years? And where's your credit rating? Below 640 credit rating, in most cases, a FICO. These online lenders generally aren't at you. And if you're in the below 640 crowds, you don't necessarily need to fret. It may not be actionable immediately to make change, but then again, it depends on the overall circumstances. Often, though, the situation results from unpaid collection items when you're below that 640. And from my personal experience and working with other clients, those are usually often exceptionally low balances, maybe tens of dollars, maybe a few hundred. They can be unpaid utility bills, cell phone bills or cell phones, items you may have signed on that somebody else didn't pay. And there are other times it can be larger amounts stemming from medical bills, judgments, repossessed cars. And at the end of the day, the amounts, large or small, they're simply debts. And they have the biggest drag on your score. And and so these things need to be addressed prior to, which is why the extra discretionary income in your using some of the other tools that I'm giving you in this course and will give you, I'll work in conjunction to make it possible for you to take control of this situation. Now, regarding the items and collections, the first item at hand is to see what tools you do have to address the issue as immediately as possible. You also need to rank them. What's the smallest balance? You need to have progressively higher balances. And then note the interest rates, because there's two different concepts I'm going to introduce you to here in a second. There are two approaches. You can either try to attack the highest interest rate first, or the lowest balance first. And when you're attacking the lowest balance first, it's called that snowball. Who's in the personal finance space, who's very much about living debt free. I'm not sure if he coined that term or not, but I'm going to give him credit for it. I'm mistaken or not, so that's on you. So anyway, the benefit to that, and I see it more so, especially with people who are more impulsive spenders, that they need that early psychological gratification of getting something paid out as quickly as possible. Let's say it's a $60 a month bill and you only owe a few $100 well in a month or so. Guess what? You just paid that off through savings from other areas, right? Maybe getting that second job or getting side hustle, whatever it is. You get that paid off, and then that frees up that $60 a month, and then you can apply that to the next, or the debt of the next raised amount, and so on and so forth. But the gratification cycle is much more frequent than the other end of this, which is the debt avalanche. The debt avalanche is where it doesn't matter what the balance is, you're just paying money towards the highest interest rate first. And that may or may not be the largest balance. So you're going to have to be aware that you're not necessarily going to get that gratification right away. And if you're a longer time horizon person that doesn't need it, that's great. But a lot of us, I would say probably most of us, myself included, like those little warm feelings when we get a sense of progress, even if it's not necessarily the most economically efficient right away. Let's see. So anyway, once you make room in your budget by freeing up that money, you can either accelerate your payment, which is always recommended. Um, I tend to use a hybrid model myself, will recommend it. And the thing that I found that helps me a little bit more, especially when I'm in a situation I had very little. I had basically no money left, is that I did push a little harder, got a little extra cash, and then paid off one debt that was about that $60 a month, it was 53 and change every month. And I owed to something. And I knocked that thing out, and then all of a sudden, the next month, I didn't have that 50 some odd dollar payment. But what I did, instead of taking all that 50 some odd bucks, I needed a little breather financially, even if it was only 20, 25 bucks. I took half of the money that I had reclaimed, and so that was discretionary and disposable again. And then I applied that towards the next highest debt, just like I explained with the snowball method. And then I kept the other half in my pocket so that it took some of the psychological pressure off that desperation, that want. I would suggest that some people they need or might want to use that sense of desperation and maintaining it artificially as a tool. But for me, I think I have anxiety issues that I don't need the extra anxiety. And again, that's some gas money, that's extra gas money, it's extra food, it's whatever you need. It's not an extra pizza. It's an emergency fund because I didn't have an emergency fund at that time because that was depleted because of my circumstances. Something to think about there. Another aspect of debts that you need to consider are collections, judgments collections. We talk about judgments we talk about it in a module, but collections in general can consist of judgments, for example. So you got to ask the question: are each of the judgments large, small? Is there a mix? Where do they fit in the debt snowball situation? Because if you have just one collection, that could drop your credit score 50 points, sometimes more, and you're in the 500 range. And if you can just get one of those settled out, then within usually 30, 60 days, you're going to see a significant increase because it will show as paid in full, or settled for less than a note, which may or may not be something you would consider because literally everything is negotiable. And they spend money trying to collect this money from you to begin with. So it's not economically efficient for them to try and shake you down all the time. So the settlement usually works out fairly well if it's on mutually agreeable and attractive terms. So just for a second there. Okay, I want to make sure I had it. Um, One of the other things that you might consider is taking a look at what resources you have. And again, I mentioned this in another module about liquidating things that you have dust, but there might be something that you haven't thought about that may or may not be available to you. And that is, do you have a cash value whole life insurance policy? Because many of them have terms where you can take loans based on the cash value at very attractive loan rates that can potentially help you take care of some of the collections, take care of some of the payments, or even get rid of some of these debts. And you may or may not even have to pay this money back. I recommend you do, just because A, you're paying interest to yourself, and you might need it again later. So why not? There's just no reason not to, I think, at least in my opinion, barring you're already of extreme age or you're having health situations. Anyway, so if you're committed to financial reform, tools like that are very useful. You can also consider reaching out to family that you trust and that trust you for either a temporary loan or to perhaps help you pay or settle some of these things on your behalf. However, these people are your lifeline and you want to take care of them. I do not recommend stiffing family. I do recommend, however, if you have somebody who might be open to helping you, that you tell them exactly what the situation is, be transparent, and give them a realistic expectation of when they can see their money back and how long it'll be before they start seeing any payment. Because some people aren't going to be getting that payment. while you're trying to reclaim your footing. Now, if you can utilize either of these resources, family, friends, or say a life insurance policy, and you get things settled out, you're, if you can do that and it'll get your credit rating up, and then you can get a ref or a say an installment loan from one of these lenders that I had mentioned before. Because in about 3 to 6 months at the very least, or at the very latest, I should say, um, your credit rating can jump up significantly just by getting them resolved and keeping them yourself for a few months. And once you get to a point where your credit rating is above that 640, preferably higher, 680 or better is usually the best. That's the time that it's right to really look at refinancing that debt or renegotiating it. And getting all that credit card student debt under in one installment payment that you can work with. Now, I personally did this once, so 15 years ago, and I had a business. I had closed a business, and I had been going on for a while. But when I refinanced it, the credit rating went 660 to a 740, which was insane. That was an 80-point jump. So I can't say that that's going to happen for you because I had certain things going on for me. I was current in my debts. I hadn't missed any payments, and it also was an installment loan, which I didn't have at that particular time because I owned my car for 8 years. I didn't have any monthly payments on it. So actually moving the bulk of the debt from credit cards into an installment loan showed that my credit cards got freed up, and now my debt, my income or my debt utilization ratio went down, and now I had lower payments every month. Then my debt to income ratio had improved. So it had a twofold impact on my credit score. And then guess what? Once I got to that 740, what did I do? I actually refinanced that. So the one I used at the time for the first round was Best Egg. And Best Egg gave me 14.99% as I recall. And then for a few months, I made the payments and maintained that 740. I ended up going with another lender, and I forget exactly who it was, but I got an 8.99 because my credit rating was still that much better and in a sustained fashion, and I didn't go into any more debt. And of course, I made all my payments on time. And I paid everything off long ago. But the point is that refinancing provided an opportunity to get everything under control a lot faster than I would have otherwise. If you're not disciplined, however, this is the warning. If you don't have any self-discipline when it comes to this sort of thing, it also provides you an opportunity to run those credit card bills up again. So you just dug your hole deeper. Only now you've got more complex debt situation. And again, just defeating the purpose. One thing that I ran into, somebody told me about, I hadn't done this myself, but what they would do is they had their credit cards, and that's a sidebar item I'm going to come back to in a minute, with the credit cards so that they didn't go in and impulse spend on the credit cards. They gathered all the credit cards in the house except for one. And that was the emergency one that was in their law bed. And they had it just in case. But everything else they put into this plastic jar, and then they filled it with water and they stuck it in the freezer because that was their cooling off period. They needed the one card. I think they were running business at the time through it, and it was all business. It was all being paid off every month, and that's fun. But with this other stuff, when you have that impulse to oh, I just need it, I gotta have it. But that was their safety, so that they didn't have to go ahead and make personal purchases on cards and get back in the hole after reclaiming all this extra money that getting the extra cash in their household and starting to make more progress on paying down their debt and having enough extra so that they weren't struggling, starting to generate an emergency fund. These things all work together for them, and if that may be something that works for you. The reason I point that out is, like, why didn't they just cancel the cards? Why didn't they just cancel the lines of credit? There's an argument for not doing that, and I think it's Dave Ramsey. For some reason, I was thinking of what that's the show. I appreciate his passion as well. But yes, cut him up. And I'm not saying that's right or wrong, but there is a cost to that because if you close a credit line, especially one that you've had for a long period of time, it changes your credit scoring matrix. It says, A, you've got less available credit, especially on your consumer lines, which means that if you are carrying some debt, then instead of having, say, 10% or less utilization rate, you might go up to 30% because and then the age of your average credits. Credit account goes down as well if it's one of the older accounts. So you actually end up hurting your credit rating when you do that often. If you have all your credit card debts paid off, or you're paying down credit and you're not looking back and you never want to see another credit, a credit statement again, you're never going to borrow money again, and you're committed to that, and that's what's going to happen, then okay, fine, you can cut them out. I'm not saying don't, but know yourself first and know what your long-term objectives are. You may want to keep those lines open and even modestly use just like one tank of gas once every few months just to keep it active. Otherwise, you could lose the credit line anyway through lack of use. But again, that's a self-discipline issue, and not everybody can be trusted with that. And if you're one of the people that struggles with it, maybe using debt is not the best thing for you long term, except for larger things like getting a house. Or if you're in a pinch, maybe a car, which I never recommend buying a brand new car if you can avoid it. If you drive for a living, I would, let's say you own a business, and yeah, your car reflects you and your success, your business. Be real careful about that. Even consider getting a car that's maybe just off a lease or something, a couple years old, because you could probably save about 20 to 30% off the price of a new car. So yeah, just use your smarts on that. There's so much to share on credit. I don't want to get lost in it, but the point is that these credit card companies, lenders, creditors, collection companies, they're all businesses, except for the individuals in our lives. Right? They're not banks. You have to take care of them. So, but everybody else is negotiable. So, be prepared to negotiate, do business with these businesses, and you'll be amazed what they can do. So, with that said, I'm going to leave this here, and perhaps this is something we could reach out, or you could reach out to me and complimentary agent to call and to talk about, because it's going to vary by each person's situation, the credit situation. How does this apply to this? What do I do? What are the next steps? Well, those are things that you put generate. But there's also a lot of education. So you don't need to just listen to this. This is a 17, 20, 27, 17 course, whatever it is that you need for it. And it's there to sensitize. It's here to sensitize you to these concepts and where you can look and where you can start. It's not going to solve the problem for you. You have to do that. You have to act. If you need help or feedback as far as how you can structure your action plan, that's what that call would be for as well. Happy to do it. And as long as I've got time in my schedule, that's always the trick. 24 hours in a day. Same problem that we all have. All right. Take care. And thanks again for your patience, and look forward to Secret 5.